Citi came out this morning with the second big financial company to report better than estimated earnings for the second quarter. The third biggest U.S. bank beat on the top and bottom lines, earning $1.09 per share on revenue of $20.6 billion. And our next guest is one of the most accurate forecasters on Citi stock. He's got a hold rating on it now after downgrading it back in the month of January. That's Charles Peabody of Portales Partners of Bloomberg Best. Charles, welcome to InBusiness. Do you think you made the right call back in January?
Well, in the sense that the stock has gone down, yes. The question now is really what do you do with this stock going forward?
And what is your expectation based on the earnings today?
Well, the report was slightly better than I had anticipated, and they certainly grew their book value at a healthy clip. And the stock is now trading below tangible book, whereas in January it's trading at a premium to tangible book. So it's starting to get more value.
Mm-hmm. It seems like the trend with JP Morgan and with Citi is that investment banking revenue is up, that there are some indications that perhaps the broader economy and housing might be improving. Is that the right takeaway?
Certainly on the former, yes. I mean, investment banking results, particularly on the trading front, were much better than we expected. And at Citi, their investment banking, which would be M&A and underwriting, was up very strong, both quarter over quarter and year over year. So those results in terms of revenues were much better than we anticipated. The distinction is that Citi's expenses in investment banking were up such that the 9% revenue decline in investment banking translated into 30% decline in net income. Whereas in Morgan, the net income gains were much stronger. So what it reflects is Citi's playing catch up and having to hire high-cost talent to build out their investment banking franchise.
And it seems like, in reading your latest reports, you seem to feel comfortable with the capital levels at Citi, and you feel fairly confident that they are going to go ahead with upping either dividend or coming out with a stock buyback in 2012.
I do, and I think there are two things that give me comfort towards that. One is Jamie Dimon's comments yesterday from JP Morgan that they weren't going to push beyond 7.5%. And for several years to come. So that provides some relief or cover to the other banks. And secondly, I don't think the regulators are going to demand a 9.5% Basel III requirement right up front. I think they're going to allow the banks to evolve towards that level. So Citi has plenty of capital generation capability, and the use of their DTAs, the deferred tax assets, sort of turbocharges that improvement in their Basel III capital ratios.
Yesterday we heard from Fed Chairman Ben Bernanke his take on U.S. vulnerability in terms of exposure to the European crisis, and he seemed to say there's not much real risk of truly causing calamity, crisis. When you look at Citi, they reported $22 billion worth of exposure to Portugal, Ireland, Italy, Greece, Spain. How vulnerable do you think it is, or the broader U.S. banking system is, to what we're seeing play out in Europe right now?
Well, the difficult thing for us as outsiders, let's take Citi's numbers. They've got about, as you said, $22 billion of exposure. $9 billion of it is unfunded, so it's only $13 billion that's been funded. And that's a net exposure, so they've hedged out some of the risk. What we don't know is how have they hedged out that risk, and are those hedges going to be made good? For example, in the subprime mortgage debacle, a lot of the risk was hedged out through the monolines, but the monolines, it turned out, couldn't make good on their guarantees. So a lot depends on how this risk has been hedged out and whether that hedge will prove to be good.
Do you expect over the course of not just today, but in the near term, increased volatility of financial stocks as we go through the stress test in Europe of their financial system?
Yeah, I think volatility this summer is going to be quite dramatic. Because of the deficit reduction talks, because of concerns about China's growth in real estate markets, and because of the sovereign debt problem in Europe.
Okay. Sorry, I was just listening to my producer there, Charles. But when you look forward at some of the other financials, I mean, you're looking right now at a 25% chance of a recession. You're telling me you expect increased volatility through the summer session. What is my reason to put money to work in the financials right now? I mean, what is going to be the trigger for a rally?
Well, over the course of between now and the fall, we're going to get some of the issues that are uncertainties clarified. particularly on the regulatory front. We've already started to get rules clarified on Basel III capital requirements. I think we're going to see an Attorney General settlement fairly quickly, and I think people are going to be surprised at the level of hit. In other words, it'll be less than what I think has been floated out there.
Less than $20 billion?
Well, for Attorney Generals only, yes, but there's going to be a broader package, so the numbers that are being quoted reflect a broader package. But if you're talking about just the Attorney General settlement, yes, less than $20 billion. And then I think you're going to get clarification about the deficit reduction talks. And I think we're going to get through this stress test in Europe. So I think things will start to be clarified, and what we might see is a very choppy, frustrating market, but climbing a wall of worry.
All right. Charles, thanks very much for your take on how to read these earnings today.